Today, folks, I got the red shirt. I got the red backdrop. I'm ready to discuss the insanity. There's a divergence happening between the Canadian and U.S. economies, and everything is tanking right now, leading into this discussion of inflation, interest rates. But I got two really intriguing dividend stocks right now that are literally over 10% yield. One of them is over 10%. The other one's damn near close to 10%. One, I think, is going to be the short squeeze opportunity of a lifetime. Not a lot of people are discussing it in the U.S. markets, and on the Canadian markets, I've got this dividend stock that's taking advantage of the private mortgage crisis no one's damn near discussing that could lead to further defaults in the Canadian markets. But hey, if that's a conversation you'd appreciate, hit the like button. While you're down there, if you like these discussions, you can chat about it with me privately and my 6- and 7-figure investors in my WhatsApp group that you can get access through my Patreon page. So consider supporting the channel, guys. I'm a little squirrely, a little all over the place, but that's what the markets demand right now because nothing makes sense. The markets yesterday, up, down, and then bam, everything completely tanked. Look at Tesla here, guys. Now down into the low 170s, continuing to deteriorate. The broader market's all deteriorating, and the only thing I'm desperately trying to do is get my taxes done. The bank really slow on sending me my T5s, my T5 103s, all the boring crap that allows me to get contribution room to my registered retirement savings plan because I'm going to be loading up, baby. This is opportunity time right here, and I want to get some of those broad-based dividend ETFs like SCHD where I get tax advantage. RSP waives that withholding tax. Conversation for another day, but most of you know what I'm talking about, right? If you're Canadian anyways. But let's get into this. If it's good enough to screenshot, it's good enough to sell. Quote from Warren Buffett, 1969. Obviously, completely fake, but I think these memes really represent the time that we live in. Unfortunately, people seem to still be getting hyper excited about some of the volatility, and those people are losing a crap ton of money. I think the boring investments are the ones that you want to be most prudently paying attention to. And those are the ones that are going to get you through this crazy time. I think it comes back to the point of maybe broad-based ETFs is the prudent place to start these days. Well, maybe taking 10% of your portfolio and doing what I do and make some speculative investments like I am into TSM, Aduro Cleantech, some of these smaller cap companies. I've got some ones that we're going to talk about today that are very intriguing that might make their way into my portfolio because typically I do not buy super high yielding stocks, but these ones are intriguing. So let's get into numero uno before we talk about the divergence between the Canadian and US economy. This one has to do with private mortgages because riskier, listen to that, riskier private mortgages have soared by 72% in Ontario, and now brokers fear a wave of defaults. This is a scary article here. I was looking at interviews last night and I came across this because these don't show up in bank financials because the banks I think are going to be able to survive this. Obviously there's some bank defaults in the US, but I'm telling you the Canadian economy is way stronger than the US, and I think the Canadian banks are a buying opportunity here, but we don't see these private mortgages come up on bank financials. And I was like, man, I'm not even paying attention to this. So I started looking into companies, and one that I've been following since the early days of my investing career, I never bought it, but here's a private mortgage company called MCAN Mortgage Group that yields over 9%. This company has been doing exceptionally well through this volatile market, and that's because people can't get loans from banks, so they're turning to private lenders like MCAN, which you can go to this company, give them your money, and they'll loan it out into private mortgages that yield anywhere from like 6 to 10%. There is a huge amount of risk with that. And I want to see how this company performs if we head into a wave of defaults. But I can't get over how these private mortgage companies have been really benefiting off this insane market. I'm just kind of blown away by it. Their balance sheets are growing. So it's something that I'm going to follow very precisely. And it could be a bit of an arbitrage play into the market cycle of people, maybe they can't afford the mortgages. They just can't get approved from banks. The banks have really tightened how much money they're willing to give out now. So people are forced to turn to companies like this. And that doesn't mean they can't afford the mortgages, guys. The job market is still very strong. So if you're interested in this, I'd pay close attention. But let's talk about this divergence before we talk about this other dividend stock that I'm way more intrigued by. I think is a huge short squeeze play. But look at this. This is the Canadian inflation month over month numbers. We've had multiple months of negative rates. The Bank of Canada has done something that the US definitely has not done yet, and that is that they're pausing. The Canadian Treasury, the Bank of Canada said, hey, we're just pausing. We're going to see what the inflation numbers look like. We're going to take it easy because our inflation has cooled way the F down. We're back to like nominal rates if these numbers continue to be in the low digits, the point digits, right? Now, obviously last month or January was kind of high here, but it'll be neat to see what the data looks like moving forward because in the US data is insane. The US data here, guys, if it continues like this month over month, these really high numbers, you're talking about an annual rate of 4 to 6%. And the Fed is getting really teased off about this. And they're going to be forced to raise rates, and they've said that they're going to probably do another 0.5 probably by the end of March here. And if you haven't seen this little news thing cycling here, I think it really represents the fear and the continued probably downturn we're going to see in the market. This guy highlights a lot of crazy historical facts. Take a listen to this.
Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay. And to get inflation down to 2.2%, based on history, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play.
I mean, that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation.
This is the divergence we're seeing here. Canada is proving to be a bit more resilient. That doesn't mean it's going to be that way moving forward because our economies are so closely linked with the US, but still, like, there's been no historical time ever where the Fed has been able to pull off a soft landing in moments like this. And again, it comes back to the point of always having that emergency fund, always having good liquidity to take advantage of opportunities when you see them. And those opportunities exist right now. I mean, I'm seeing them in a ton of companies, stocks. You could be, if you're looking to buy real estate, those opportunities are arising. So it's very prudent to have cash, especially in market volatility, right? But let's talk about this stock, and Medical Properties Trust. This stock I used to own. I sold it a while ago. I've been periodically following it, and this thing is going back to the 2008 financial crisis levels. It is down 63% from its all-time highs, and from the 2008 lows there, guys, it's only up 188, 200%. I know that seems like a lot, but it's not. It's really not for how low this stock has dropped, yielding 13.24%. This company is responsible for like $19 billion in hospital properties. There's 44 properties, 10 countries, 44,000 licensed beds. This company deals with general acute care hospital, behavioral health. You think hospitals are going anywhere? You think this company is going to completely default? I have a hard time believing that when I run the math on the numbers. But the most intriguing thing about this stock is the fact that there is a 26% short interest on the current outstanding shares. A hint, a slight amount of good news in this company could completely force a short squeeze, and we could see this stock skyrocket, and it's continuing to drop. It is down 10% alone today, and it's one that I've been watching, and I'm not sure if I'm going to take a position in it, but you can't help but understand the balance sheet is actually fairly resilient. I've been going through this, and when you look at the FFO numbers, some of the math behind it, it looks like the dividend is actually affordable. That doesn't mean they're not going to cut it again to give some more room for liquidity, but there's just so much going on with this company. And if I'm not going to break it down on this video, I'm going to do a specific video on it because so many YouTubers that have done much better jobs than I'm going to do just generally talking about it in this video. Like Let's Talk Money did a full breakdown. He's been putting a lot of money in this stock, and I want to show you a quick clip from Fast Graphs. This guy's done a really good job following this story, and he just gives a few little highlights. You can take a quick listen. Pretty insightful stuff.
Analyzer software tool, aka Mr. Valuation. I hope you enjoyed this video. This is our update on Medical Properties Trust, where we did our previous video prior to the earnings report, and now we've done a follow-up video. Nothing has really changed very much. Everything that I think was expected happened. The only thing that's been changing has been the price has become more volatile, but I do believe that the downside is really mitigated at this point. I do believe there's a margin of safety in this company, assuming the fundamentals don't truly deteriorate far beyond what anybody personally sees. And you can go, there's articles on Seeking Alpha now. A lot of people are really turning bullish about the company, but that isn't really of a concern to me. What concerns me is what the fundamentals look like, and to me, the fundamentals look strong. And I think it's important to have things in perspective. If you're always looking at stock price volatility in the short run and making your investment decisions solely based on that, I do believe you're making long-term mistakes. Volatility is undeniably real and unavoidable, in my opinion. But in the long run, fundamentals determine price. And in this case, I believe the fundamentals support a much higher valuation than the market is currently awarding them. And, I have a money management firm named EDMP. It stands for Earnings Determined Market Price, or, I should say fundamentals. But there's an evil twin sister that says emotion, EDMP, emotions determine market price in the short run. I believe you're dealing with a lot of emotion in this stock right now. Fundamentals seem to support a much higher valuation. But
I just want to give you some insight on that valuation, because when you go into medical properties trust, guys, you go into the financials, there's a big divergence here, because in the balance sheet, if you take a look at the assets, they're sitting at about 19.6 billion, and they've got about 11 billion in liabilities. You minus that out, they have about $7 to $8 billion in underlying asset value. The stock currently trades for around 5 billion. There's quite a bit of a divergence. When you run the math, I think the fair value market price for this should easily be in the $15 to $20 range. I don't like putting price targets on things, but I can't help seeing that this should be a $20 to $30 stock in the next 1 to 3 years. There's just something going on here that I think doesn't make sense from a lot of different levels. There's a lot of risk with this kind of stuff, but if you have that 10% of your portfolio that you want to make risk plays with, like I do, this is something that I am hyper analyzing right now and just watching this, because inevitably when those short interests get wiped, this thing has a huge potential of a 20-50% upside just from the short squeeze that could lead into any kind of good news with a company like this. But my God, there's a lot going on in this market. And I got to pass the question off to you. What do you guys think in the comment section below?